The United States maintains the largest economy on the planet, generating immense wealth and driving global trade. Behind this prosperity lies a debt burden exceeding $34 trillion. The total debt now eclipses the value of everything the United States produces in a single year. For the first time in modern history, the nation's liabilities have surpassed its annual economic capacity. National debt operates through a specialized financial mechanism rather than a conventional bank loan. When the government requires cash for current spending, it issues treasury bonds to global investors, sovereign nations, and financial institutions. In exchange for this immediate cash, the government signs a legal promise to repay the initial investment, along with a set rate of interest. While this is a standard tool for funding growth, the system creates a trap when borrowing becomes the only way to meet basic operational costs. For much of the 20th century, this government borrowing remained stable because the underlying economy expanded at a very similar rate. This momentum shifted following the 2008 financial crisis, which forced a massive change in how the government funded its survival. In response to that crash and the later COVID-19 pandemic, the government injected trillions of dollars into the economy to prevent a total collapse. Almost all of that emergency stimulus was funded through new debt rather than tax revenue. These combined crises turned temporary emergency borrowing into a permanent structural habit, pushing the debt to the current $34 trillion mark. The interest on the debt has evolved into a more immediate threat than the $34 trillion principal itself. Annual interest payments have curved upward exponentially over the last decade, consuming hundreds of billions to service the debt. These payments are on track to surpass the entire national defense budget, eventually eclipsing total federal spending on healthcare. This massive overhead drains the national budget, leaving fewer resources available for infrastructure, education, or public services. The government has three primary ways to cover these rising interest costs: by increasing taxes, by printing money, or taking on even more debt. Raising taxes carries a high political cost, while printing new currency to pay off old obligations directly devalues the money in every American's bank account. The U.S. government has entered a new phase of borrowing money purely to pay the interest on its existing debt. This creates a dangerous closed loop where new debt produces no economic growth, only higher interest payments in the future. Given the scale of this math, it is worth asking why the system has not already reached a point of collapse. The current stability relies on the US dollar's status as the world's reserve currency. Because global markets use the dollar for international trade, they maintain a high level of trust in American debt, allowing the US to borrow at a scale impossible for any other nation. International psychological confidence provides the sole foundation for this $34 trillion structure, standing in for gold or hard assets. This trust is finite, and the risk increases as the debt continues to grow faster than the underlying economy. Should that trust vanish, a mass sell-off of US debt would flood the global market, crashing the dollar's value and triggering a cycle of uncontrollable inflation. For the average citizen, this macro-level failure results in significantly higher prices for basic goods and a sharp reduction in purchasing power. The system functions as long as economic growth can outpace the cost of the debt, but the current trajectory shows the math of the borrowing trap moving faster than the real economy.